If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Sean Winslow. Let's dive in.
Hey, Axel, welcome to the show, man.
What's going on, Sean? Thanks for having me. Looking forward to our conversation here.
Hey, no, thank you for taking time out of your busy schedule. I know this guy. I know I just spoke about this in the intro, but we have a connection. We both invest in New Hampshire, and we both have either currently live or have lived in Boston for a long time. So we got that connection. We're both invested in the same markets, and I think you guys are really going to love this show. I'm going to let him get into his what I call the origin story, but he's finding a lot of deals in cool ways, off market, taking them down a lot of deals. He has this. He just posted about it on social media actually over the weekend, and we could get into that unit discussion because I think that's a great debate to have. But he just hit one of his big goals of a certain amount of units by a certain age, and he's crushed it already. So I won't spoil any more. So I'll let you take it away from here. Tell the listeners a little about yourself, Axel.
Yeah, absolutely. You touched on a couple of the high level points. First being, grew up in New Hampshire. So I was actually born in Northern Mass, but really spent, all of my childhood in Southern New Hampshire. So grew up in a small town. Parents were entrepreneurs. They actually grew a wood chipping business. So nothing to do with real estate, totally separate business, but was kind of exposed to that early on, which, was great for me and wanting to figure out what I wanted to do. Right. And I very early on figured out that I was going to run a business of some kind. And that was going to be, really just how I made money outside of corporate America. But, so long story short, flipped everything I could get my hands on growing up. And eventually by the time I was in high school and kind of early college, I was buying and selling cars. So found cars on Craigslist and was, making a couple of bucks doing that, and quickly realized that I would like to buy and sell something that was larger, try and make, basically grow that side hustle into something that was a little bit more of a business. So stumbled upon flipping houses in researching, trying to figure out what else, people buy and sell. And, eventually if you Google, just flipping enough, you're going to end up on flipping houses. So started to learn about that and learn about the real estate business. And as I was learning about flipping houses, I stumbled upon, rental real estate and multifamily real estate. Really just the whole concept of passive income, and quickly realized that seemed like a better route to go. Just the scalability of the business and, conceptually the idea that you can do the work once and kind of get paid forever was pretty appealing. So basically my foray into real estate was doing a small 3-unit deal while I was in college. And basically that's what gave me the bug, and started buying, small multifamily properties, the 2 to 4 unit deals. Using a lot of private financing and, kind of doing the BRRRR strategy, right? That Bigger Pockets has made pretty popular in the last few years. And over, the first few years in the business, just grew a portfolio of, 20, 30 doors and kind of replaced my income. And I got to a point to where I was about a year out of school, where I was like, I could keep doing this full time. It's probably going to get pretty challenging if I keep on doing this full time, because the lending was a challenge, because I was, trying to do that and find loans, and it was getting, really hard because at the time I didn't have a job. That was my full-time, quote unquote job. So I actually moved out of New Hampshire, went to college up there, moved down to Boston and took a job. And for me, I was like, I'll keep doing real estate on the side and grow my portfolio, and I'll have, my day job to help me with lending and to, another source of income. And a few days into my job, I got a call from a seller who received one of my direct mail pieces, and he had a 12-unit apartment building up in Manchester, New Hampshire, which is where I was buying at the time, and would have been the best deal that I ever would have done. Left me a voicemail telling me the price that he wanted, telling me all this information about the building. By the time I listened to it, I was on my way home from work, and I was like, wow, I cannot believe that I missed that phone call. And by the time I called him back, he accepted another offer from another investor. No. And I was like, okay, well, we're going to have to figure out how to do this full time, because there's just way too much upside here. So I left my job a few days in, and it was funny. My boss was like, yeah, dude, you got to go do that. I don't know why you're here. That seems like it's way more interesting than working a sales job here in Boston. So that was a couple of years ago, and I've been full-time ever since. And since then, we've been slightly growing the business in terms of the size of the deals we're doing and the geographical locations, I should say, that we're buying in. And now we're buying a lot of nice multifamily properties throughout various markets in the country. We're raising money from passive investors. We have a vertically integrated property management company up in Manchester, which is where the bulk of my personal portfolio is. And things are humming along pretty smoothly. So hopefully that wasn't too long, but I would say that's the holistic origin story.
No, that's great. I didn't know that aspect about the W-2 job for a little while and then losing out on a deal.
Yeah, that's what took me down to Boston. I, basically moved down, signed the lease, had this job lined up, and 3 days in, that happened. Right. And I was like, it's really hard to have a full-time job and to actively go out there and source deals and to try and, quickly build a real estate portfolio. It's hard to do both in tandem. I mean, a lot of people do, but for me, I was like, that the job I took was particularly demanding. And, it's just kind of that wake up call where it's like, dude, you got to go full, you got to go all in on this. Right. There's a lot of opportunity there. So it's funny. That's how I ended up in Boston, which is funny. Ironic. Yeah.
Sign from the gods, man.
Yeah. Sometimes it's how it goes.
And listeners, he did mention a strategy that I want to kind of, for the newer listeners, he mentioned the BRRRR strategy, which is, it's just buy. So you're going to buy the property, then you're going to rehab it. So you're going to fix it up. Then you're going to rent it out to newer tenants that are paying a higher rate than they were before. And then you're going to refinance, pull your money out. Like in the good old days, you probably could pull 100% of your capital out. And you still can find, situations where you can do that today, but it's getting tougher and tougher. So you pull out 100% and then you just repeat. So that's what BRRRR is. And that's a great way to start off in real estate and build a portfolio. But yeah, that's a phenomenal story, because unlike a lot of people today, you essentially, you're doing this all yourself. I mean, now you're syndicating, of course, and for some deals, but you've built, your personal portfolio through this strategy, through connections. So one, I just want you to touch base on the post you made on Instagram about you achieved one of your goals, and just tell the listeners what that is. And then two, I guess we can talk about, is that the goal that we should be obtaining?
No, it's a great question. And, it's a funny discussion. And that post over the weekend, I had like a ton of great comments, or debates, I should say, in the comments of that post. But at a high level, the goal was when I got out of school, 22 years old, or I just turned 23 a few months after graduating. And, I was like, hey, in 5 years, I want to own 150 units of real estate. And there was no real reason that I arrived at that, other than sounds like a cool number. If I'm doing, let's say $100 a door in net cash flow, really conservatively speaking, $15K a month in passive income, that's a great lifestyle to be living. Right. And that's a great thing to strive for. So for me, that was kind of like set the bar high type of goal. And then it's funny, once you set goals that are that far out, oftentimes as you're going, you're like, wow, I set that bar a little bit too low. But that was really the goal for me, was, grow a portfolio to 150 doors by 28 years old. That was kind of the time bound goal that I set. And, I'm 27 now. We closed the deal last month. That was a 40 unit portfolio up in Manchester, New Hampshire, that put me at 170. But it's funny, as I kind of reflect on that, and this is what I posted about on Instagram, the post you're talking about, where I'm looking at the unit count, the thing, because I had it in my bio on my Instagram. It was this whole thing. Right. And, kind of reflecting on that, I'm like, unit count really shouldn't be the goal, because it's honestly such a misleading metric. Right. And I think everybody in multifamily real estate uses units pretty loosely as kind of a gauge as to people's experience, the size of their portfolio, how much money they're making, right. Their balance sheet, all this stuff. And the unit metric is just so misleading in a lot of ways, because, and this is what I talked about in that post, where there's so much that goes into what a unit count is, right? I mean, I own a small piece of a general partnership of a 104 unit deal in Houston. That wasn't something that I included in that unit count, because I'm like, those aren't really my doors, right? I don't personally own a 104 unit property. But at the same time, a lot of folks in this business would say, hey, that they throw that on their unit count and they'd say, I'm 300 units in, that's the size of my portfolio, or something like that. And the reality is that, the example I used is, I know some folks that invest around Boston, guys in their 50s and 60s that own 10 3-unit buildings, right? They own 30 units in, within 10 minutes of the core part of Boston that they bought, 20 years ago or something like that. And that was their retirement plan. And they have no debt. There's no partners in those deals. That guy is worth way more money than the guy that owns a few percentage points of a 300 unit portfolio or a 300 unit asset, right? So on paper, one guy's talking about how he owns 300 doors, and that guy seems like, he's living large and he's making more money than the guy that owns 30 units. But in reality, the guy that owns 30 units is living a much easier lifestyle, a much better lifestyle. He's making more money. He's worth more money, right? So I think that's the challenge with the unit metric. And the only reason that I say all that is it's a really misleading one to see on social media, right? And obviously that's where I was posting about it. I was posting about it on Instagram. And, if you look at other people's social media profiles, it says multifamily investor, 550 units. You don't know what percentage of those units that person owns. You don't know how heavily leveraged those are. You don't know how many partners he has. There's so many things that go into that, right? So for me, I bring that up because a lot of the portfolio that I've built is, small multifamily properties that I've, found the deals off market. I've financed them with private lending. I've put my own cash up to buy them, and then I refinance the money out. And a good chunk of those I don't have any partners on, but, probably 90, 100 units there I do have partners on. Maybe I own 25% or 35% of the equity in those deals. So I just, I think that at a high level, what I'm getting at, and I'm being long-winded here, but so I'll wrap it up. But I think it's just, there's a lot that goes into assessing somebody's portfolio. And fundamentally, if I were to go back and, set a different goal, it's not unit count. It would be, what's truly my monthly passive income, or, some kind of balance sheet goal or something that wasn't unit driven, because it's so up to interpretation, I guess is what I'm getting at.
Yeah, I couldn't agree more. I think I even commented, I even made a comment about that, about the passive income, because you're right. The unit count can be so misleading. There's a lot of people out there that are getting into the game, and that's nothing against them. Like, this is a great place, like, more power to them. I don't blame them. We're in it. Like, I can't argue that. I love the space. But when you go out and say, like, I remember there was probably over the summer, there was one deal that went around where it was like 500 units or something crazy, $100 million portfolio, or it might've been just one property, but it was massive. And all these people on social media were talking about how they just took it down. Well, it's clearly that, like, all of you don't own like 20% or more, because that's over 100. So it just can be really misleading, both from, if you want to be a passive investor, like trying to find an operator, like that could be misleading. Oh, this person has 1,000 doors, but how much do they own? And then two, for anyone like you and I who are growing our business, or even people that are, a little greener than us, that can be kind of misleading and make them feel like, wow, am I not doing enough? It's like, no, but if you're someone like Axel, who has 70 units, 100.
Yeah, that was kind of the calculation I put together, right?
Yeah, 170 units, yeah. And you own like 20 to 30% or more. That's way more impressive to me that you've grown that than someone who got in a 500 unit deal and owns like 1-2%. Like, yeah,
exactly. And I do want to just say for the record too, it's unit counts matter, right? Because when they do matter in the sense that if you're talking to a broker, or you're talking to, somebody that's a service provider, right? It gives you some context as to your experience in the business. If you're like, I'm a general partner on 1,000 units, and you give a little bit of a clarification, like, I personally syndicated, 100 unit deal, and I found the deal, I raised the capital and all this stuff. And you give some context. I mean, that's important, right? Because it validates your experience. I think that where unit count becomes tricky is guys see a newbie go and do 100 unit deal, and they're like, that's crazy. Like, I want to go, I want to go do a 100 unit deal. I want to find a deal that big. When in reality, he's posting about it on Instagram, but maybe he brought, $100,000 to the deal with like a family friend or something, and he gets 0.05% of the general partnership. And it's like, that guy could have literally went and bought a single family rental, and that would have been more impactful to his balance sheet, to his net worth. So I think that's where it gets tricky is, if you're new, just go buy a 4-unit deal. Like, go buy that with your own cash, your own money. That's going to be a much better use of your time than going to, trying to go out there and buy some large deal and partner with, 7-8 other guys. It's just, that's so much more challenging. Right. So I think we should stop thinking about unit count, and start thinking about, can I actually put a nice chunk of equity on my balance sheet, right? And that's going to actually help you, I think, gain more momentum and achieve those passive income numbers that everyone's trying to achieve, right? I think that's going to be a better way to do that.
Couldn't agree more. And you don't have as much control when you have 0.01% of a deal. So
Exactly.
your future is a lot of your control. But let's talk about how you grew your portfolio. I think this is really fascinating part of your story. So you're at 170 units. How did you do that?
Yeah. So early on, I realized pretty quickly that if you're going to scale in this business quickly, especially if you're using your own money and, you're trying to make every dollar count, you got to go out and find off market, really, really discounted deals. Excuse me. And what I did initially and what we still do now is a lot of email marketing and a lot of cold calling and just a ton of networking, right? So I've done some direct mail. I found a few deals through direct mail, and that's a great avenue. I don't think I'm an expert in direct mail because I do what everyone says you shouldn't do, where I send it one round and then I don't do another one for another 4 or 5 months. So I have gotten some deals through direct mail, but I'm not an expert, so I won't talk on that. But a lot of what we have done is pull data lists of owners, find the true owner, right? Not the LLC that owns it, but find the true owner, do what we can to find their email address. And just, like you would if you were working business development at a software company, right? And you're reaching out to your buyer. We're just reaching out to owners, building relationships, getting to know them, getting to know their situation, providing value. We'll send a lot of newsletters, updates on the market, updates on their property, national market updates, and just try and organically build a relationship over time, with the hope being that when it comes time for them to sell, we're somebody that they're calling or emailing or giving a heads up to. So a lot of the deals that I did early on, a lot of the 3 to 10 unit deals where I was buying it personally actually came through that channel. And the goal there was, hey, maybe we can find some deals here and maybe we can, actually grow a portfolio by doing this. But number one goal is, hey, we're going to actually go out there and just meet other investors. And that ultimately is going to be what brings the deals. So while we were doing that, we were also spending a lot of time networking. I say, it's really me and a couple of guys that were helping me find deals early, and was really active in the local real estate meetups, was really active online. When I started the Instagram account, for example, which is about a couple of years ago now, I was really, really intentional about networking with other people that were deal finders, whether we're brokers or wholesalers or flippers or whoever. And just letting everyone know that we were buying deals. So I tried to cast a really wide net in the markets that I was in and pair some of the direct to seller email marketing stuff we were doing, and some of the cold calling we were doing as well on a kind of a smaller level with a lot of the, networking relationship based deal flow. So I would say those were really the 2 main ways we approached it. And it allowed us to find a lot of those, really discounted smaller deals that helped build the portfolio initially.
That's awesome. And I think, the whole networking thing, I think listeners, if you ever really anything you want to do in life, but, when we're talking about real estate here, if you want to find investors, if you want to find deals, you need to network. You need to go to all the meetups you can go, because at the end of the day, you want to surround yourself with the people that are doing what you want to do. And that's where they all go, because that's the place to meet. And I've met some great connections going to meetups from every aspect of the business, from capital side, from the deal side, from the operations side. And I wouldn't be where I am today without going to these meetups and networking. And I cannot hit on that enough. So I appreciate you bringing that up.
And I'll dive a little further into that because I think that, I have one more thing to add there. I think especially as a lot of folks transition out of their quote unquote, day jobs or their W-2 roles into real estate. One of the biggest hangups is that, when you're working for somebody else, it's 5, 6 o'clock at night. That's when your workday ends. In real estate, when you're trying to find deals or raise money or do any of the things that separates the average investors from the great ones, 6:30 at night is when your day starts in a lot of respects, right? The real estate meetups that are the 6:30 to 8:30, that dollar per hour use of your time to go to stuff like that is so much more astronomically huge than anything you're doing from 9 to 5. And, going to those dinners, right. Or going and grabbing a beer with with another investor. That's what's moving the needle in your business, is the stuff that you're doing when it gets dark out. And I think it's hard for people to kind of, understand that as you make that transition, because, the deals they're happening during business hours, of course, but like, that's where a lot of that deal flow comes from, or, investor capital comes from. And, as you do larger deals, and, we're doing some slightly larger deals now, a lot of the, 10 to 50 unit type deals, that increasingly becomes the case because those deals are increasingly found through relationships and networking, and less, as a percentage of all the deals you find through direct to seller or some kind of marketing, right? So that becomes a critical component of your business. And I'm in a lot of the networking groups, and a couple of smaller mastermind groups, and I'm trying to be really active in all those. And that's where all of that comes from, right? So I just wanted to throw that in there too. But that's what that's what I've really focused on. And I think that's what's helped grow the business quickly for sure.
Yeah. And so you find these deals, talk about the networking aspect, the email aspect, and some, a mail. But now, so once you get a deal, how have you been structuring these, using traditional financing, private lenders, capital partners? What does that look like? And I'm sure it's probably morphed over time.
Yeah, absolutely. And I'll kind of break it up into two stages, right? When I was doing my own deals, and that still applies to some of the deals I do on my own now, because I'm still doing some of my own deals, and then, deals with investors. But doing my own deals, it was a whole lot of private money lenders or hard money lending. And, it was just, let's get the loan balance as close to the purchase price as it possibly can be, so I have the least amount of cash out of pocket. And then I go, gangbusters on the renovation plan, or the value add plan if it's a multifamily. And then I just refinance my cash out, right? And try and keep that velocity of money in mind and keep the money rolling. So, for example, a lot of what I was doing early on was, 6-unit deal, 400 grand. Maybe it's, going to take 60 grand in rehab to really get those rents up. I had a couple of great private lenders that would loan all of the purchase price. And then I would fund the rehab out of pocket, understanding that we're coming in at such a good discounted purchase price that their loan to the current value is actually pretty safe, relative to if I were to just close it and put it back on the market or have it appraised or something like that. So that was something that I did a lot. And then I would, just piece together the renovation money through cash flow, or, just kind of, pulling cash from other properties and using that to pay, for the renovations on another deal. And I was just living pretty frugal. So it allowed me to kind of, amplify that whole plan. But as we started raising money from investors, that obviously changes, right? Because you have to raise for that specific deal. You can't commingle funds. All the money that you're raising is in one entity for that specific deal. And basically the way that we structured it is similar to a lot of other folks in terms of how people are structuring syndication deals, where, there's some kind of preferred return, some kind of equity split. Maybe there's some fees involved, but, we don't have like a standard structure for all our deals. For example, this 40-unit portfolio we just did, we did it as a joint venture. So we didn't do a true, 506B or C syndication. We basically just put together a few large capital partners into an operating agreement. We gave people, some percentage of the upside. Everybody, is going to be somewhat involved in the operation of the deal, and that, we'll have a quarterly asset management call and talk about how the deal is going. But fundamentally, me and my two business partners on that one, we're really going to be the ones that are running that deal. And we structured that as a 9% preferred return to investors. And then anything above and beyond that, we split 50-50. So we have a nice aggressive equity split on that because the deal could justify it. So we structure deals in a lot of different ways. And really, it's just a function of we play with the preferred return. We'll play with the equity split. If we increase that preferred return, then LPs get a slightly lower piece of the upside. If we decrease that pref, then maybe they get a slightly higher piece of the upside. And we've done a lot of stuff through the joint venture model where, maybe there's one or two active investors, and then we'll bring in a few passive investors and structure in a way to where we're not crossing, securities lines, but we've kind of put it together in a lot of unique ways, since we've done a lot of deals that are smaller in size, $1 million to $3 million in purchase price. But we've also done the syndication model, and we've raised some money to help other people take down large syndication deals, and we're participating in the general partnership of those deals. But long story short, it kind of runs the gamut. But I think got the business off the ground by leveraging private money in a really significant way. And then we've kind of amplified the business by taking in a little bit of investor capital. And now that's really becoming a core focus of the business, is trying to do more of that as we speak, late 2021, as we're talking now.
That's great. And I think that just highlights that in real estate, there's so many ways to get in. It's not like other industries where it's just like that cookie cutter. This is how you do things. there's so many ways to be tactical, flexible. And, I wish I had started at your age. It's so impressive what you've done by 2027, 170 units. You just took down, what was that, 44 units?
40 even.
40 unit deal. Yeah, that's massive. And 9% pref. Yeah. Ooh, I wish I was one of your investors. That's amazing.
No, the investors love it. For us, it's like, let's go save the money on, $15,000 syndication docs, raise bigger chunks of capital from a fewer key investors. Their projected IRRs are 18, 19, 20% on that. C-class deal in New Hampshire, right? It's kind of a different return structure than than an A-class deal in Tampa, right? I mean, those returns, you're not finding those in markets and products like that. But we're like, we're local operators up here. We're vertically integrated. Like, we can tell a really compelling story to investors. And the reason that it took me so long to raise capital was I was so hyper vigilant and paranoid about like completely over delivering that I just didn't do it sooner. Like, I was so like, if I'm projecting an 18, 19% IRR, like I want to hit 30, I want to hit 40. Like I want to really, really deliver for the people that are trusting me with their capital. And I mean, that's kind of still the case. I mean, obviously that's still the case, right? I think that's any syndicator's or any sponsor's goal, but like, we're so hyper sensitive on what we get into deal wise. We'll get into a deal and we want to offer upside to the people that are partnering with us, especially because a lot of them are coming in with big chunks of capital, just as a nature of who we're bringing in as investors, that we really want to, we want this deal to make our next deal an absolute no-brainer. You get an email, you wire money in a couple of days. So that's just kind of how we would approach the business. But yeah, I mean, I think, the returns that we've delivered are, in terms of the projected returns, I should say. So the projected returns that we're offering are kind of commensurate with, smaller market, a bit of a different type of product than, a market that's, popular online, something that a lot of folks are moving to in the Southeast in a more, B or A class deal. So I think there's a lot that goes into that, but needless to say, I mean, there is certainly a million ways that you can approach this. Like you mentioned, I mean, there's so many structures you can employ.
Yeah. Which makes it, the barriers to entry pretty small, relatively speaking, for people to get in and be creative. Where are you finding your capital?
So it's interesting because as an active real estate investor and someone who's primarily networking with other active real estate investors, it can be hard to transition into the capital raising side of the business, because typically the folks that want to invest passively are, the busy professional types that aren't in real estate specifically, or if they are in real estate, they have such a surplus of cash that, that they're able to do that. But for me, we've monetized a lot of the active real estate professional types. So the brokers, the house flippers, the wholesalers, the lenders, folks that aren't necessarily buying multifamily real estate or sponsoring multifamily real estate deals. And what I found motivates them most significantly is honestly the tax benefits.
Yeah.
We do a lot of cost segregation stuff. Obviously there's all of the benefits of investing in multifamily real estate from a tax perspective, with the depreciation, taking losses on your K1. So the active brokers, right? I mean, I have a broker that he's invested in a few of our deals, and he's like, that huge loss on the K1, I mean, that's offsetting my active real estate commission income, right? Which is taxed at a completely different rate than passive income. And that's enough of a reason to invest, that obviously the deal matters, but like, that's the first reason, right? And then the other reasons come after that. So that's where we're finding a lot of investors, just because that's what my network has organically become, just as I've networked throughout the years. And now I'm really starting to consciously network and, try and meet folks that are the busy professionals that, they're making a couple $100,000 at their day job and they want to go invest in real estate. And maybe that's less of a motivation for them, but the other reasons are the bigger motivations. So that's what we've done. And we've also partnered with, other operators, other active real estate investors, and sliced up the upside of the deal in a way to where it just makes all of our lives easier, right?
Yep.
If we're finding a deal and we're bringing in somebody who can bring, 40 or 50% of the equity required to close the deal, sure, come in, we'll give you some of the promote. We'll structure this in a way to where it's beneficial to you. Let's get you in on the asset management side of this. And that's going to make our life a lot easier from a capital raise perspective. So we've done it kind of in a number of different ways. However, the primary source, if you want to short answer the question, right? If I were to sum it up, is a lot of active real estate folks that really like the tax benefits and just other operators that could bring their investor base, or they could bring a big check, and it just makes their lives easier.
That's a great point. The active real estate people in real estate that are active, one, you don't have to explain to them why real estate. They already get that. But then on the flip side of the coin, it's like, yeah, well, they usually want, a part of the deal, which, I don't blame them. They get it. And so it's kind of that tough balancing act. But the point of the tax benefit, I think, is huge. And that's what I always try to, play up when I'm talking to them, is that, hey, look, you're making a lot of money with whatever you do, whether you're a broker, agent, lender, you're making a lot of money. Well, this can help you reduce that tax burden. And, at the end of the day, we can make a deal work, we can make that work in terms of a type of structure that you're comfortable with. But I think that's a great point. That whole tax thing is what's really incentivized them. So I'm part of a mastermind, and it's run both with a multifamily and a single family, two different groups. And so they've been reaching out to us like, hey, I just made a crap ton of money this year, and my accountant said I got a problem. I had, too big of a tax burden. So now they're looking to put money into our deals because of the, cost segregation and bonus depreciation, which, listeners I've talked about in the past, just a tax strategy. And how Axel mentioned, you get this K1 has a huge loss. It's, depreciation loss, and that can really help, with that tax burden. So that's a great point. But that's impressive that you've been able to, a lot of your investors are active, because I do have some active real estate professionals that are investors, but they're definitely a small part of it. So it's quite impressive.
Yeah, I think it's just functionally just become a result of I've been an active real estate investor, and everyone that I've met when I've intentionally gone out and networked the last 5 years I've been in the business has been in really just active real estate folks. And I haven't really been intentional about meeting the passive investor types, the business owners, the attorneys, the doctors, all those folks, right, that we all commonly hear about. So I just haven't organically had those folks in my network, right? And being a younger guy, you're a younger guy too. My circle of friends, I should say, hasn't, kind of my college friends, my close network, the people that kind of know me just personally outside of real estate. Still a couple years to go before we're writing big checks into real estate deals.
Right.
So I think that for those, I think that the people who are, early 40s, right, and they're leaving a career in technology, and they've worked with hundreds of, people in Silicon Valley that they can go to when they start raising capital. I mean, that's a totally different type of person, right? And it's easier for them to tell their story too, because they're leaving this high paying job to go raise capital for real estate. They can show their friends who, were working right alongside them a year ago and say, hey, this is what I'm doing. This is what's really working. It's hard for me to tell that story because I don't have a lot of folks that relate to that story outside of the people that I've professionally networked with in real estate. So I'm kind of just been working with what I've had at my disposal. But as I say all that to say that at this point, a lot of what we're doing now is trying to build the database of folks that are, the busy professional W-2 prototypes. So it's constantly in flux, but you're right. The tax benefit component for the active real estate investors or the active real estate professionals, I should say, is like so critical. I mean, like you said, I know a wholesaler in my local market who's, probably going to take in 300-400K this year. And his accountant's like, dude, you got to buy some of these deals and hold on to them. So his accountant's telling him to do it personally, and he's picking up a duplex here and a 3-unit there. And I was like, if you throw, however much money into a deal and you actually look at the bonus appreciation, the tax that you would pay on your earned income from wholesaling is enough of an ROI in your investment outside of the passive income, the equity pay down, all of that other stuff to make this a sound investment, right? And that's really eye-opening for a lot of folks, I think, once you have that conversation that are, active professionals in the business.
Yeah, that's a great point. And then, that ROI just from the tax benefit can make a lot more deals work for them too. So,
exactly.
So that's a great point. All right. So you crushed your first goal of that 150 unit count. What's the next goal for Axel?
That's a really good question. I haven't necessarily set another one. I think a lot of what I'm doing now is trying to think about what I want the business to look like just from a day-to-day perspective. I think a lot of the goals that I'm going to have over the next year, for example, are going to be more people oriented, more bringing people onto the team. Within the next, I would say probably 6 months is kind of what I'm thinking right now. I would love to hire a full-time director of acquisitions that is a sales-oriented role that's going out there and just filling our pipeline with deals, right? That's participating in the upside, that's getting paid a salary. And, at some point in the next 6 to 12 months, I'd also love to hire a full-time content creator, someone that can take all of the content side of the business off my hand. So I think I'm shifting to an approach to the business in that I would love to have a team of 4 or 5 full-time folks that are enabling me to really focus on the big time decisions, the networking with the investors. I'd love it if my calendar all day long was a couple of checking calls with the team and then calls with a bunch of qualified investors. And that just becomes my day, right? I'm trying to, that's my goal, I should say, is a day that looks like that. And that's what I'm kind of working towards. And, if we were to actually assign a unit goal, right, which we've already talked about is not necessarily the goal, but I think if I were to really narrow that down, I would love to be, the majority general partner in terms of I want to have the majority of the promote on, 1,000 units within the next 3 years. That's something that I've been kicking around in my head. So, not that I'm owning 5% of the general partnership. I want to go out there and find and essentially raise the capital for 1,000 units in the next 3 years. I think that's a realistic goal that is achievable. And, if we continue on the trajectory and we make some of these, key team hires, I think that's certainly something that's possible. So I would say that's probably, some kind of actual metric goal. But the real goal for me in the short term is grow the business to a point where I can afford to bring in a few full-time people that I really like working with that allow us to blow the business up. And I think that's kind of what I'm working towards in the short term.
Yeah, I realized that too in the last couple of years. If you want to scale by any means, it always comes down to people and the right people. And we've been talking about that offline about VAs, full-time people. Yeah, and it's just another thing that we have to put on our plate so then we can offload more.
Exactly. I mean, it's hard. It's something about, I think it's because people call it real estate investing. People don't necessarily look at it as a business oftentimes, right? And I know when I got into business, I just had this thought of I'm going to own a bunch of real estate. It'll just be me and, we'll cash the checks every month. And, as you obviously get into the business and achieve different things, your goals change. But now it's, this could be a real business with payroll, with staff that makes my life a lot easier, that allows us to grow to 1,000, 2,000 units or something larger than that. And I think that's where my focus has shifted is, now when I'm listening to podcasts or reading books, they're not necessarily real estate books or business books, right? And that's kind of where I've started to look, or how I've started to look at the businesses. Real estate's the product, returns are the service to the investors. And how do we actually grow that? And what does the team have to look like?
No, that's great. Well, before I ask you the last 2 questions, where can listeners connect with you if they wanted to?
Yeah, absolutely. So really active on Instagram, at Multifamily Wealth is the name of the Instagram. You can find me on LinkedIn if you search my name. And if you want to go to our website, we have some resources on there for passive investors, some educational resources that are great downloads. That's www.alignedrep.com. So it's short for Aligned Real Estate Partners, which is our company. And I also host a podcast as well, which Sean's episode is either, I think it just came out or it's coming out shortly. Oh, nice. I got to go look at the upload schedule, but the Multifamily Wealth Podcast is the name of it. So check that out as well.
Yeah, it's an awesome podcast, guys. I listen to it as well. So definitely check it out. All right. Final 2 questions. Listeners are probably used to these by now. The first, because this is not only a real estate investing show, but also a personal finance show, because it's not what you make, but what you keep. Kind of like it's not about the unit count, it's how much monthly income you're making. So first question, why multifamily investing? Why is that a great place to put your money and build wealth?
Yeah, I think that a lot of folks listening probably understand the conceptual components, right? So I'll breeze through those and get to what I actually like about it. But the fact that housing is obviously a need, right? It's just a fundamental need, and there's an extreme shortage of housing in America. Just simple supply and demand. Your money is probably going to be safe in an asset class like multifamily. Historically pretty recession resistant within the real estate industry. It's easily financed. There's all these reasons why it makes sense as a real estate asset class. But from a business perspective, the reason I like it so much as an operator and as somebody who's running a business within multifamily real estate is that it is highly scalable. Typically, once you start doing slightly larger deals, the pie is large enough to work with multiple people and to share roles and responsibilities. You could build a capital raising system, with a great investor base that allows you to put together capital in a scalable fashion. It's typically a pretty lucrative business, so you can afford to hire great people to handle a lot of the stuff like asset management and property management. So fundamentally within the real estate business, it is a scalable asset class, which is why I've been focusing on it more and more, and why I've tried not to get distracted by the shiny object syndrome of Airbnbs or single family, flipping or, self-storage or some of the other stuff, right? Self-storage is scalable, but I don't understand that business. But for me, I'm like, multifamily scalable. It makes sense for me to spend time growing that business because I know that there's a fundamental need from an investment perspective and from a business perspective. It's something that I can scale and grow relatively easily.
No, I couldn't agree more. And I know that it's always the shiny object syndrome. It'll get you, but got to keep on track. All right. The second question is, if you could go back in time, tell your younger self one piece of financial advice, what would that be?
This is a really good question. And I've been thinking about this because I knew it was coming. You mentioned that it was coming. I've had a couple of answers kind of pinging around in my head. I think personal finance from not a business level, but a personal level. I think I would have focused on investing in the key relationships in my life, much earlier, I should say. I think I had a scarcity mindset. I think everyone that's younger kind of has that to an extent, right? They don't really want to spend money because they don't know when it's coming back in terms of investing it in, a business or in somebody in their life. Right. But I think a great example of this would be, I wish I had just taken more people out that could have been mentors for me and paid the check and sent them something really nice after a meeting as a thank you for taking the time to sit down with me and spent money in ways that really nourish relationships that would have been key to my growth. A lot of the other decisions I made, I think I look back, I'm like, I'm kind of glad I made those decisions, but that's one where I think, I would have spent a little bit more time being cognizant of is identifying the people in my life that could have advanced my career, whether it was real estate or personally or what have you, and really invested time-wise and financially, obviously specifically to this question, in those relationships.
Hey, that's a great answer. I think that's one of my favorite yet. It's all about the network, and
that's all it is. It really is. It's so simple, but we lose sight of that.
I know. I mean, whatever it is, I don't know if it's, the scarcity mindset, like you said, or just, we don't have, faith in ourselves or confidence in ourselves, or we think we just have to do it all alone. But it's so true. It's all about the network. And I love what you said is leading with value, pay for the lunch, send them something nice after, offer to do whatever you can to make their life better and easier, because in return, you're going to get a lot bigger, return ROI, because learning from someone that's doing what you want to do. So I couldn't agree more.
Yeah.
Well, Axel,
exactly.
I thank you for your time, my friend. This has been an awesome show, and I know the listeners are going to get a lot of valuable information out of this. So thank you.
Absolutely. Really I appreciate the invite. This was a great conversation, and look forward to it coming out and staying in touch.
Yeah. And maybe we'll do a deal together in New Hampshire or anywhere in the country.
I mean, I'll do it anywhere, wherever you want to do it. I'm game. So you tell me.
Let's do it. All right, everybody. Thanks for listening. We'll catch you on the next one.
Hey, this is Sean Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course, share it with a friend who needs it. See you next week for another great show.